Joining us now is Mark Fields, former Ford CEO and a CNBC contributor. Mark, there's so much to talk to you about where the auto industry is concerned. We'll start here because Tesla is such a big mover and does have such an outsized impact on the market and is certainly still seen as the leader in EVs. Your thoughts on the dynamic pricing that we see this company on a near daily or at least weekly basis employing?
Well, I think what you're seeing with the latest moves, again, it's a situation where they're ramping up production and they obviously have a demand issue, and therefore they're reducing prices here in the U.S. I mean, they were very strategic in the S and the X price reductions, where now they're going to be eligible for some of the federal incentives. So clearly they have a demand issue as we go from kind of early adopters to mass adopters of electric vehicles in the U.S., and you're seeing their pricing reflect that. And I think that's what was reflected in their stock price today.
If I expand this out more broadly to pricing, particularly here in the U.S., it almost feels like the auto industry is going through something kind of similar to the housing industry. It's a sector that tends to be more interest rate sensitive because people are taking out loans against new and used cars. You've had these supply-demand imbalances with supply not there in recent years in the pandemic, and it seems to be holding up. Yes, prices are down if we look at Manheim year on year, but still so elevated versus just a couple of years ago. Where do we go from here? And I guess, how does that factor in then to, let's just start there. Where do we go from here?
Well, I think overall, Morgan, what you're still seeing a lot of pent-up demand in the marketplace. I mean, with the supply chain issues over the last couple of years, inventories right now are still nowhere near where they usually are at this point in time of the year, although they're up 70% more or less from last year, and that's why you're seeing some of the automakers increase incentives. But I think, to your point, when you look at what's happened with pricing, I mean, the average new car loan is over $760, which is up about 30 to 35% versus where it was back in 2020. And the same thing for used cars. So you have a situation in which affordability, literally, you have to make over $100,000 a year just to afford a new car. And what you're seeing in the marketplace, and what you started to see in just this past couple of months, you're seeing prices start to come down. The average transaction prices are off their highs that you saw in December and September of last year. And I think you'll continue to see that. But it's all buttressed by a lot of pent-up demand that's still out there in the marketplace and will bleed off over time.
Mark, zoom out for me here. Talk about the U.S. automakers. If I were an investor, I'd be afraid to buy the domestic automakers when EVs are the future. They take fewer people to make, but the United Auto Workers are pushing for a contract here that one might argue is going to create some structural challenges for the U.S.-based industry. What's the counter-argument?
Well, first off, again, when you look at this transition to EVs and you look at the average age of what they call the vehicle park or the population of vehicles here in the U.S., it's over 12 and a half years old. So that will get turned over time. Vehicles are getting older. They need to be replaced. To your point, John, when you think about the UAW contract coming up, you know, labor represents plus or minus around 10% of the cost of a vehicle. That being said, these negotiations are pretty pivotal because when you look at the all-in labor costs for, let's call it the Detroit 3, they're about $65 an hour versus the import non-union companies, which are about $55 an hour, versus Tesla, which is about $45 an hour. So when you look at what the UAW has been asking for, which is over a 40% increase over the life of the contract, and when you add up some of the other things and benefits that they've come in with their opening position, I mean, you're looking at widening that disparity, you know, significantly. And the automakers cannot afford them.
Can they get half of what they want, and it still pencil out?
It'll still pencil out because when you think about it, John, the Detroit 3 sell a lot more large SUVs and full-size pickups than some of their import competitors. And those have quite nice profit margins on them. But at the end of the day, as this transition to EVs happens, I mean, let's face it, EVs right now, with the exception of Tesla, nobody's making money. And as the automakers, the legacy automakers ramp up, they're going to have to work down the piece costs to get those EVs to an acceptable margin. So you could argue for a period of time, there's going to be a restructuring of their margins. And that's why every penny counts in building a car. And that's why I think the automakers are going to be quite strong in pushing back on some of these demands from the UAW in their contract negotiations.